What is up, everyone? Welcome to Investing Club. In this video, I'm going to show you how to value financial stocks like banks to be able to find the best bank stocks to invest in. And I personally am a pretty big fan of bank stocks because I understand how banks work pretty well, and I've found that their earnings tend to be pretty stable, which helps me estimate what the value of bank stocks are. But valuing banks is a little tricky because it's different from valuing most other kind of companies. With most other companies, you can plug in the discounted earnings to some sort of intrinsic value calculator and it'll spit out the value. With bank stocks, that doesn't really work. If you try to use one of those calculators, it'll spit out some weird number. So you have to do things a little differently with bank stocks, but once you learn how to value them, it becomes pretty easy to figure out what they're worth. So what I did was I made this spreadsheet and I'm going to show you how I value the big three banks: Bank of America, JP Morgan, and Wells Fargo. And then I also threw in the bank I own, Bank OZK, which is a small cap regional bank. And so if you're looking for a book that will tell you step by step how to value bank stocks, this is a book I would recommend. It was actually one of my subscribers that reached out to me and he wrote this book. He is a senior banker and he wrote this book, Bank Valuation Demystified. And so I gave it a read and I actually really liked it. I think especially for beginners, it'll really help show you step by step how to value banks. So it'll be the first link down in the description. Highly recommend you give it a read, especially if this is something that is new to you. It's good to get your hands on all the material you can get. So here's what I did to value these three bank stocks. I used three different methods. For the first method, I used the classic dividend growth model, and this is a very basic valuation technique. If you take a finance class anywhere, the first thing they're going to teach you about valuation is probably a dividend growth model. The second method I use is the price to the tangible book value. This is one of my favorites for bank stocks because it's simple and it gives you a good picture of the margin of safety you're getting when you buy into a bank stock. And the last one is the discount from the historical PE ratio. So like most stocks, banks also trade around a normal PE ratio. So if you use the average earnings multiple that a bank has traded at in the past, you can compare that to where the valuation is today to see if it is potentially overvalued or undervalued based on the historical PE ratio. So the first one is the dividend growth model. So the dividend growth model, if you've never heard of it, it's a pretty simple formula. All you do is take the dividend that's going to be paid out next year and then divide that by the required rate of return and subtract the dividend growth rate. And this is definitely a formula you can play around with. I put a note, I assumed that the required rate of return was 8% just because that is considered the normal market return. If you invest in an index fund, it is likely over the long term you would average around 8%. So that is just what I put, but that could definitely change from person to person. So that's something to keep in mind. But with those numbers, here are the values that I got. For Bank of America, using the dividend growth model, I got that there was a value of around $24. For JP Morgan, I got a value of $90. For Wells Fargo, $21.47. And for Bank OZK, $34.67. And so for the colors I use for the most undervalued bank for each valuation method, I put in green, and the most expensive I put in red. So using the dividend growth model, Bank OZK looks the most undervalued with its estimated value being $34.67 and is only trading at $24.30 currently. And the most expensive is Wells Fargo, which looks overvalued based on the dividend growth model, which is saying Wells Fargo is worth $21. And Bank of America and JP Morgan's price are both pretty close to that estimated value. So if you want to use the dividend growth model, all you have to do is look up the estimated dividend that will be paid next year and then look up some analyst estimates on what they think the dividend is going to be, and then subtract that from your required rate of return. I like to use 8% since it's the normal market rate of return, but again, you can play around with that number. So the second valuation method I used is price to tangible book, and this one again you can find with a simple Google search. And so Bank of America has a price to tangible book of 1.24, JP Morgan 1.67, Wells Fargo 0.9, and Bank OZK 0.92. So looking at this metric, JP Morgan looks pretty expensive with a price to tangible book of 1.67, and on the other hand, Wells Fargo looks pretty cheap with a price to tangible book of 0.9. And Bank OZK also has a price to tangible book of under 1 at 0.92. And price to tangible book is something I like to look at with bank stocks because if it's under 1, it usually means the banks are undervalued. The tangible book value is basically the real assets that a bank has. So theoretically, we can say if tomorrow, if Wells Fargo shut down and they liquidated the company, they sold everything, they sold all their buildings, all of their assets, they sold off all their loans. If the price of tangible book is under 1, what that means is you would get more money per share than the shares are currently worth. And that gives you an added margin of safety when valuing bank stocks. And so I always feel more comfortable when I buy a bank under its tangible book value. And that's not always the case, and it doesn't really work well with stocks that aren't bank stocks because most other companies aren't valued based on tangible book value. It doesn't really mean anything to a lot of companies in different sectors. So that's something I only look at for bank stocks. And the last thing I'm going to look at is a discount from the historical PE ratio. So like I said, banks usually trade at some normal valuation for the majority of their life. Right now, we just saw a huge stock market crash, so obviously the banks are going to be valued at a lower valuation than what they were in the past. And so that's what I'm taking a look at with here. All of the banks on this list are at a discount from what they're normally valued at. Bank of America has the lowest discount at only 19%, and Bank OZK has the highest discount at over 100%. It is at 110%. And so what that means is, Wells Fargo has a discount of around 50%. So what that means is the Wells Fargo stock would have to double to get to what it's normally valued at, and Bank OZK would have to double twice. And so based on that metric, a lot of these banks are undervalued. I don't really like using this method as much because there are a lot of problems with it. The first is that the valuation, the PE ratio, is based on the future expectations of the stock. So obviously right now, with all banks doing poorly and it's unclear how their loans are going to perform, and it's expected that their earnings are going to take a drop, it makes sense that these banks are valued lower right now. That's why when I see stocks that are discounted 50% from their normal valuation, I don't think it really means much. You can take a company like Bank OZK that was growing at over 15% a year, then yeah, it's going to be valued pretty highly. And now when that company has seen negative earnings growth for the past couple of years, that valuation is going to shrink a ton. So just know that to get back to these historical valuations, the expectations going forward for these companies have to be the same for it to make sense. Again, this one is pretty easy to find out. You just Google search the stock name average PE ratio and then it'll come up. So this just shows that valuing stocks doesn't have to be some insanely hard thing with a bunch of formulas. It can actually be pretty simple if you know the basics to it. Again, these numbers don't mean anything unless you really understand the company and have a clear idea of what they're going to do in the future. So do not take this as financial advice. I'm not recommending you buy any of these stocks. I'm just using these to show how I value bank stocks. Now, that being said, if I had to buy one of the big three bank stocks right now, it would probably be Wells Fargo. They are looking extremely undervalued, but something interesting about them is that the dividend growth model actually suggests that Wells Fargo is overpriced. Meanwhile, the price to tangible book and the discount from their historical earnings multiple shows that they're undervalued. So what that really tells me is that Wells Fargo's growth is slowing down a ton because the dividend growth model takes into account the growth. But on the other hand, the price has taken a hit so badly that it's trading below its current tangible assets. So that's something to note too, how you can use these valuation methods in conjunction to figure out more of the story on a stock. Wells Fargo is going to be a slow grower, but it's just undervalued compared to what's on its balance sheet right now. So that's something to keep in mind. That's probably the stock I would buy. But again, I own Bank OZK, and I still think there's a huge opportunity in the small cap regional bank sector. The ETF is ticker KRE. So that's something I've talked about in the past, and I would take a look at if you're looking to diversify into this area. I just use the most common three big bank stocks as an example, but if you take a look at some of those smaller cap banks, the valuations are insane. Some of them are trading at a price to tangible book of 0.7, 0.6 or lower. And so whenever we see the economy start to recover, I expect those banks to fully go up to their normal valuation, which could be doubles in price or even more. So again, if you want to learn more about this concept, check out Hamza's book. It'll be the first link in the description. It's called Bank Valuation Demystified. And if you like this video, hit the like button, subscribe to the channel if you want to see more videos like this, and I'll see you on the next video.